name is John Bay, and welcome to another edition of our More Than Market series. I'm Senior Vice President, Chief Investment Officer at NEI Investments. On our last More Than Markets call, my colleague, Shalon Williams, touched on the geopolitical risks and their implications for the economy and the markets. Today, I'd like to expand on this topic further as the situation in Russia-Ukraine has intensified, causing more market volatility and geopolitical instability on a global scale. So let's unpack this whole situation and talk about what it means for the markets and what NEI is doing about it. First and foremost, when we think about the Russian-Ukraine situation, this week's headlines were horrific. It is Europe's largest land war since World War II. Already, we've seen 1 million plus refugees pouring out of Ukraine. There's a 40-mile line of military convoy near Kiev. And it's some very concerning news that Russia attacked Europe's largest nuclear power plant, with the news that it was actually set on fire last night. And so maybe I'd like to start off this first and foremost, that if you have any friends and family that are directly impacted by this war, you do have our support. We wish you and your loved ones, in terms of health and safety, the best outcomes for your loved ones. But in terms of the market implications, on paper, the Russian-Ukraine macro impacts actually look quite small. From a GDP perspective or a company earnings perspective, Russia and Ukraine are just tiny percentages on a global scale. But the ramifications of this war are actually quite large, particularly from a European perspective. On the energy front, Russia supplies about 40% of the European natural gas. And already we've seen the effects of this war with the benchmark gas price in Europe more than doubling this week and is at all-time highs. Europe was already suffering from an energy crisis before this conflict, and the war just exacerbates this even more. And the energy implications are not just contained in Europe. There are global oil ramifications as well. Reports coming out of Russia right now is that their exports are down on the oil front by about 1/3 already. And we haven't even seen sanctions on Russia exports yet. And so this week, oil's up 20% to about $115 a barrel. And the prospects are that this could get actually a lot worse, say 150 barrels of $1 a barrel before it gets much better. So why does all of this matter? Well, first of all, energy prices have a huge effect on the economy. They're effectively a tax on the economy, as high energy prices really affect the manufacturers and businesses as their costs go up and earnings go down. High energy prices also affect consumer spending, as eats into their discretionary income. And with less discretionary income, they have less to spend on other things. For instance, there's already reports that gas prices are hitting $2 a liter in Vancouver. And what this means is that people are going to go on less road trips, spend less money when it comes to restaurants or buying other big ticket discretionary items. And of course, high energy prices are inflationary. Not just about gasoline in your cars, but we use energy to heat our homes, and it's used to transport. The transportation costs for goods have just gone up as well. And all of this, matters, it's in the sense of it's actually a really bad time, because the CPI numbers, as we all know, are already at extremely elevated numbers. Like, for instance, the US CPI last month came in at 7.5% at a headline level. That was already the highest since the last energy crisis in the early 1980s. Next week, the next CPI print is about to come out. Analysts are expecting about 7.9%. What that means is that if there's an upward surprise to headline inflation, that means headline inflation will have an 8% handle, just giving more urgency for central banks to move. But before we get to central banks, I just wanted to mention one last thing, which is supply chain disruption. Earlier this year, regular people on this call will remember that we were hoping that supply chain disruptions would dissipate as the year went on. That is, as central banks began to raise rates, consumers the demand would begin to cool off, giving businesses more time to get their logistics organized and get the supply chain disruptions in order and putting lower pressure on the supply chain. But now that we're in a war scenario in Europe, that scenario is off the table. we are now not worrying about overheated demand, but we're worried about the war actually creating sanctions and disrupting supplies. What I mean by that is take Russia. It's one of the smaller economies, but it's a big exporter of commodities, both on the industrial and agricultural supply chain. Everything from aluminum to palladium to wheat are big components of Russian exports. And take the auto sector. Palladium is actually a key component in non-electric vehicle automobiles. Russian aluminum also affects steel production, et cetera. So we have additional supply chain worries to worry about now as well. And all this means is that it's just a tricky time to be a central banker. Before the war, the markets and investors were really priced in about 6 rate hikes for both Canada and the US. With investors not being surprised if the central banks were to do a double hike or and start their quantitative tightening program, meaning selling off bonds in their portfolios. Well, with all of the geopolitical uncertainties that have been created in this environment, a lot of that has been priced out. The Bank of Canada, for instance, have walked the tightrope earlier this week. They instead of hiking twice, doing a double hike, they've only raised it by 25 basis points, and they gave no timeline on quantitative tightening. We have later this month, Federal Reserve Chairman Powell has already come out and said that he's in favor of a 25 rate hike, basis point rate hike, not 50. And so again, we're beginning to see the central bankers having to weigh a higher inflationary environment with the more political uncertainty and tightening of financial conditions, even without the central banks moving here. So all of this, what does all of this mean for the markets? What this means is that there's going to continue to be market volatility. And when it comes to market volatility, our message here really hasn't changed. In this environment, we just encourage investors to lengthen their time horizon. Just remember that market corrections are often the best time to be investing. With global indices down across the board, there are many good companies that have great balance sheets, strong earnings, good pricing power that's needed in this inflationary environment that are trading at much better prices than they did a month ago. In terms of where we want to be investing, for instance, in one of our tactical portfolios, we recently put 5% of cash that we had on the books. As we were concerned about this market volatility, we raised some cash. We're now starting to deploy that cash. But where are we deploying that cash? We're deploying it in in those developed economies that have very strong political stability, and so that would include North America and Canada and the U.S. But for now, we stayed away from deploying additional monies into Europe and emerging markets. Longer term investors will be rewarded there. We're very confident of that. We just think it's going to take some time to get through this messiness. In periods of volatility, we also think dividend income is also very attractive. And again, a strong source in very defensive sectors. And this just brings me up to our last point. On a lighter note, and I know that the war and the volatility, there's lots of bad news here, but NEI, we recently, this week, launched the NEI Clean Infrastructure Fund. And again, we're really quite excited about this launch. It takes advantage of a couple of trends, which is this energy crisis in Europe has really emphasized the need for countries to have a secure energy supply. And particularly in Europe, being dependent on Russia for your energy is just creates energy insecurity. And so there's been a lot more emphasis on the renewable energy sector as a way of securing that domestic energy. The Clean Infrastructure Fund invests in some of the cleanest utilities across the world that have very high dividends. So it has very defensive characteristics with a strong tailwind as we need to increase the amount of clean energy if we are to meet our Paris Accord commitments. That's all I have for now. Thank you for tuning in. We hope you found today's discussion helpful. Watch out for next week's edition of our More Than Market series. As always, reach out to our NEI representative with any questions. Thank you, everyone, and stay safe.